Okay, we're now starting this. Firstly, welcome to our first webinar, trading from the Philippines. This is the first one. We're slightly nervous about how it might actually work out, but so far things seem to be okay. You can ask questions, so please feel free to do so, especially, unfortunately, most people can hear as well, I can gather. So if somebody can't hear, then we need to, unfortunately, probably a problem with your computer. So apologies for that. Anyway, this is where we are, just so you know, we're in the Philippines, and it's now about, I think, 7 o'clock in the evening, so it's quite dark over here. But the sound of the sea in my ears is quite pleasant. And we plan to go through a few questions first, so I can get this thing to actually scroll down, which it seems rather low to do at the moment. The first question we have is, should I trust the market, even though I've had 3 endowments, all of which have failed to make any money? While I answer this, or at least Mark's question will be next, I'll sort out why this thing won't scroll down. But it's a very strange question to me. Why should we trust the market? I mean, the market, as we know, is a manic depressive. It's the last person you would trust. The market is not to be trusted. The market is to be exploited. And that's really, as traders, what we do. We look for opportunities, and we try to make sure that we get in at a good point, with a view to making a profit, certainly there is no trust involved. I mean, the main activity of many market participants is in fact quite the opposite of that. The main activity is to try and exploit their fellow man. Not all of us, of course, but there are situations where people try and hit other people's stops, for example. So trust doesn't come into this. It's an opportunistic activity, and we have to accept that. And the market just is. It has no real feeling for any of us, and so it is opportunistic. So Mark, can I ask you to answer your next question, and meanwhile I'll try and sort out why the PowerPoint will not be doing what it should be doing.
Okay, thanks John. Okay, well firstly, good evening from myself, from the Philippines, and welcome to the first webinar held by myself and John. So for me today, the objective is to make sure you all leave with at least one piece of information that's going to help your trading. So remember, it just takes one piece of information to make a big difference. Okay, so I'm just waiting for John to... Okay, so the first question is, how can I set up a system that would impose strict discipline on my trading? I always give back my winnings. I need to have a way of controlling how many trades I do. It's all very well saying we need to be disciplined, but for most of us this is an almost impossible task. And I think we can pretty much all relate to this. I mean, this falls into trading psychology. Now, for me, trading psychology plays a huge role in success in trading. So it's a prime reason you can give 2 people the same system. Let's take POM for example, and over a 6-month period you might have one person who's gained a lot of profit over that time, but the other person might have actually had a result of a small loss. Okay, so it's a big reason that at my recent seminar I spent some time teaching the ways to overcome psychological problems, as it really does play a massive part in success. So in connection with this question, it's very important to understand your personality. So by the looks of it, this all links to overtrading. Okay, so overtrading, usually it's tied in with a belief system that the more trades we do, the more profit we're going to make. Well, actually, that is the opposite. Okay. And also, being human beings, we are naturally impatient. You know, we all want instant gratification. So these are all problems that everyone has, all around the world, who are trading professionally or non-professionally. So what can we do? Well, first of all, if you're going to make money in the markets, you need to treat trading like a business. Okay? So all businesses have strict risk constraints within the structure. Okay, so if you want to make money and you're treating your trading as a business, then you also you need to have strict rules in place. Okay, so if you're running your business or you're working for an employer, you're going to adhere to those rules. So when you're trading, you need to adhere to your own rules as well. Okay, you are your own boss, but you need to be disciplined. So if you're following a system like POM, you need to follow it with 100% discipline and consistency, and the profits will take care of themselves. I mean, personally, if I'm trading, if I've made a successful trade, or I may have even had a loss in the market on a particular day, I will close my laptop for trading. Okay, so I do not want to be subjected to problems which arise from overtrading. Now, if I close my laptop, then that's not going to happen. So you know, that's a key point which I would recommend you taking forward. Okay, John.
Thank you, Mark. Let's go on to the next question. Which again stopped working. Oh dear God. Give me a second while I just sort this out. Okay, what are the main differences in strategies between intraday and longer-term trading? I think probably the biggest difference is actually stop in many ways. As I've been trading for such a long time now, 25 odd years, I think I've found that it's much nicer to, much easier really, to just look for the big turning points. And I guess March 2009 is one that sticks in my mind. At that time, the technical trader, with the big call service, we gave a big call to buy. At least we certainly said this is the major buying opportunity. I can't recall precisely when, to be quite honest with you, but I do recall a couple of trades of myself. I bought RBS at 12, I think, and I bought Barclays at 120. Now, these trades met with rather different results in the sense that, let's start with Barclays, which went horribly wrong, really, because it went down to 50 the next day. So I got in at 120. I just bought shares. You know, it wasn't particularly geared. Just bought shares, and the next day, the thing gone down to 50, which was a pretty dramatic, fall. I wasn't too delighted with that, as you might imagine. But my strategy was simply to get in. I thought, well, these prices are ridiculous. The government's put so much cash in, they can't. It's just not possible they're going to let the whole thing go belly up. And I felt that my stop, if you like, was that value thought. It wasn't. I didn't have a stop in place. If I had, I'd been stopped out almost certainly. And the thing really bounced up, and I made money on that share. And RBS was a much easier trade in the sense I got in at 12. The low was 10. I think possibly the next day. I can't remember again exactly precisely the timing of the thing. But it shot up dramatically. And that's kind of trading I think makes the most money, to be honest. That's really why I've gone away from shorter-term trading into longer-term trading. Well, I think probably as I've been 20, 25 years, I've been doing it a long time. I think age is a relevant thing. I mean, I think that Mark is younger than me. I think he's day trading is much more interesting, much more vital. And of course, with the systems he uses, he makes good money in the marketplace. But it's more a question of, I think, the stop, because you can't really not use a stop with shorter-term trading. You tend to be quite highly geared, and so you cannot afford. You have to have some kind of stop point in place to make things worth doing in the first place. But the longer-term stance, you buy something or sell something at an extreme. I mean, I know a number of my clients bought or sold the dollar at 2 to the pound, which was, of course, a great place to do that. And there are these major turning points. You won't get it. You won't get in at the high or the low. You may well have maybe in a few months of sleepless nights, depending on your. Well, no, you shouldn't. That's not true. You shouldn't do that, because you shouldn't have put yourself in that position. You should accept that when you take the position, that you only put in so much, so it doesn't bother you. You don't want to be stressed out by it. But certainly, in recent years, the most money I've made is that kind of trading. And there's quite a big difference really about it. I mean, you obviously have to have some cash to do that kind of trading, whereas short-term trading, people sometimes get into it because they haven't got much cash. They want to make a lot of cash. Psychologically can be quite difficult for them. But I hope that's answered that question. Mark, over to you.
Okay.
Here is the question.
Okay, so December the 1st is my, well was now, the first anniversary of trading, and I am still solvent. I might be 50% down on my pot, but I am still here. So my question is, does it get easier? It sometimes seems like one step forward, two steps back. Well, in my case, when I first started trading, it was more probably about 10 steps back and one step forward. So I can certainly tell you it does get easier. But obviously, with any kind of business, it takes time, and with time comes experience. But if you've got a good foundation on your trading, and when I say foundation, I mean a good strategy, a good system that you're following 100%, then the rewards will follow. It's very, very important that whatever you're following, you know it inside out, so you become a specialist. Accept random probabilities in the market as well. It's something that comes part and parcel of trading, and we have to accept there's going to be losses along the way. So eventually you get to the point where it's 5 steps forward and only 1 step back, and suddenly things change quite a bit. So, in conclusion, keep persevering. Those who give up never get anywhere, but those who keep persevering are always the ones, are always the successful ones. Okay, John?
Thank you. I always struggle with the right stop level. Too close, I get stopped out of a good long-term position. Too far, risk putting a big loss when the position does not go as planned. What are the criteria when assessing? Stops are the single most difficult aspect of shorter-term trading, which is really why longer-term trading is so much easier, really. You get rid of the stop, and everything becomes a lot simpler, really. And of course, therefore, when choosing a stop, the big difficulty with stops is that the market is always probing for business. It's always looking for areas where people will trade. So just putting the stop in the market, which many people do, is an invitation to trade. You're saying, well, here I am, I want to trade at this level. Okay, you don't, but you're signaling your willingness to trade at that level. So the whole stop issue is a very vexed issue. And it is the biggest problem we have as shorter-term traders. I mean, I tend to personally, it does depend on whether I'm in the longer-term position or shorter-term position, but when I'm day trading, I still do a bit of day trading, I tend to be fairly tight in my stops. I tend to just look at the chart, and because of my hit rate, thanks much actually to what Marcus has brought into my trading, it's pretty high now, about 70%. So I tend to get out quite quickly where things don't go right almost immediately, because normally it does, in effect. So I will look for a fairly tight stop. So, for example, if the market's falling away from say 5940 or something, and sort of hesitating, then I might just put the stop, and that's only say 20 points away. I might just put the stop above that level. Similarly, longer term, I'll be looking beyond fairly major support or resistance levels. I think the middle ground is difficult. I think if you're trying to sort of play a middle game, then that can be more difficult because you're not actually playing the long-term game, so your stop is a bit vulnerable. And similarly, you're not playing the short-term game, so your stop is probably further away than you might like it to be. And I think the middle ground is often a dangerous place to be because the majority tend to go for the middle ground. It's from that human nature, really. So I think it's partly the rationale behind your strategy, and partly just deciding. You've got to be a bit flexible. You also got to be you mustn't be too concerned about your risk, really. If you're a bit fearful and you're worried about a few points here and there, then you're going to be stopped out one way or the other, even if you just bail out yourself. So there are a number of issues here. I mean, the reason I use acceptance, and those of you who get the Big Call service or John Piper trading, will know all about acceptance, is that it allows the market to go beyond your stop, to an extent, and you still stay in the position. So that's quite important. I mean, there's a question coming up about spikes, and that's a way of avoiding spikes. Anyway, Mark, over to you.
Okay, so the next question is, why do you trade the FTSE only, and why do you not concentrate on things like Wall Street or Forex, as these markets tend to move in greater volume than the FTSE? And this was actually the most popular question that I have received over the last couple of weeks. I think I had about 10 questions on this. So let's start off with my rationale on this. So for those of you who've been following the service since the inception, you'll know that I've concentrated on the FTSE for over 8 years now. So I know this index inside out. So I know what to expect pretty much on a day-to-day basis. So I have methods in place which I've created over the years which now produce me healthy income. So there really is no need for me to go and look elsewhere. I don't need to go to the Dow, I don't need to look at Forex, because I'm already creating a nice income. So it really is better to be a specialist than a trick of all trades in this business, in my opinion. In fact, by looking at too many areas, you're most likely actually going to lose more money, because you're spreading your skill set and your knowledge over a wider area. It's far better to focus on one area. For me, it's a big reason why people continually jump ship from a different system or a different strategy, because they're not putting the time in to learn one particular area inside out. I mean, if we take the example of a GP, a general practitioner, a doctor, they get paid a certain wage, but obviously another profession in the medical world, for example, a plastic surgeon or a pathologist, they will get paid a lot more. Why are they getting paid more? Because they're a specialist in their field. Okay, and the same applies to the trading arena. Yes, and I will agree the FTSE doesn't have the greatest volume when we look at it compared to Forex and the Dow Jones. But to be honest, I see opportunities every day. In fact, in my opinion, the FTSE is probably the most consistent market that there is out there. And when we're trading, we're looking for increasing our probabilities, and we do that by reoccurring patterns. And on the FTSE in particular, there are reoccurring patterns which occur time and time again, which you can take advantage of. And I think this week, when I've just started this new morning alert service for you, a lot of you will, you've seen the evidence. Pretty much all the setups. We missed a few entries, but pretty much all the setups this week did meet their target. It was our risk control which meant that we didn't enter a few trades. So, I mean, that's my big reason why I focus on the FTSE only, and it's the reason why I'm going to continue focusing on the FTSE going forward as well. Okay, John.
Thank you, Mark. Right, so on to the next question. By the way, we're going to look at your questions as you ask them in a very short while. We're just going through a number of questions first, and then we'll be looking at the questions you're asking. Okay, so let me just... every time I think I've found a trading system that works for a few months, I find it stops working. Is this typical, or should a mechanical statistical system that generally generally works only suffer a small period of drawdown before coming good again? This is actually one of the big problems with trading, I suppose. We have quite a low tolerance, many of us, to losses, and many of us, if we see a trading system that hits a loss, 4 or 5 losses in a row, for example, bail out and decide it's not working and give up and go and do something else. And of course, all that happens is they go and do something else every couple of weeks or so, and they never can expect anything because of this problem. Every system will have drawdown periods. So yes, it is typical. You must expect any mechanical system to suffer periods of drawdown, and possibly quite substantial periods of drawdown. You need to be aware. I mean, one of the reasons that the POM, for example, system on its third, well, certainly it's had two 10+ winning streaks this year, and now I think it's up to seven in the last number of trades, 7 winners, and it never has these sort of big losses, which is it's hugely beneficial. Whereas something like PBW, Profit Before Work, which I used to call PDS, doesn't have that advantage, but still has an edge. But because the system does hit string of losses, people stop using it, and it is actually the biggest problem, I think, or one of the biggest problems with systems, is that they do this. All you're doing is applying an algorithm, i.e. a formula, to the marketplace, and the market will go through phases where it plays along, and go through phases where it doesn't play along, and you have to expect that, and you mustn't risk too much in every trade. That's why 2%, 4% is the right kind of amount. For example, if your system has a 50% success rate, then every 1,000 trades, you're going to see 10 or 11 losses in a row. And you can check that by tossing a coin. If you toss a coin, then that's the kind of result you'd expect. That the maximum number of heads would be 10 or 11, and the maximum number of tails would be 10 or 11. Of course, people don't complain about the profits; they're not talking about the losses. But yes, it's absolutely typical, and it's what you have to expect. And if you don't expect it, then you just get shunted out and go into something else and find the same thing. So I hope that answers that question. Mark?
Okay. Okay, the next question is, I keep getting attracted by the MACD indicators, as it seems every good move is so often precluded by a crossover followed by a widening gap in the 2 lines. Is this a good indicator to trade on? Okay, I mean, personally, I don't use indicators when I'm trading, and I know that John doesn't use them either. The reason I don't use indicators is because an indicator is really just price data, i.e. your chart with prices plotted, and it's just interpreted in a different format. Okay, so, but by using an indicator, you're using delayed price data. So for me, if you're looking at an indicator and you're using delayed price data, it's very, very difficult to gain an edge in the market. For me, when you want to concentrate on getting an edge, you need to be using a leading indicator. So for my morning alerts that I've been doing recently, we're getting in before or just as soon as the market opens. Okay, we're anticipating, we're predicting what the market is doing. We're not reacting, and that is a huge difference between using lagging indicators like the MACD and RSI as opposed to leading indicators. Now that said, I do know people who do use the MACD who do make money. So I think it's very important that if it works for you, then follow it. We all have very different personalities, and everyone who trades the market finds a unique way to extract money out of that market. So if it works for you, then continue. But personally, it's not for me. Okay, John.
Thank you, Mark. Let's go on to the next question. Yeah, we've gone too far. Yes. How do you see the markets going in the next 3 months? Okay, well, as I've been saying in my reports, it looks like we're seeing the end of a five was up from March 2009. The chart patterns I showed in the video clip this morning, in fact. I imagine most of you have probably seen that. And it looks to me that, that we're going to see a typical peak probably early in the new year, in fact. It's looking that we have Christmas coming up very soon now. New Year, traditionally there will be a rally. The markets seem to support there will be a rally. We've fallen asleep last week. We have expiry coming up, option expiry coming up next week, and there's a question about that too, so I won't discuss in great detail right now. The chart pattern is a little bit obscure. I mean, it suggests if we do go up now, we might go up quite sharply, which doesn't really tie in perhaps what we're seeing at the moment. And also with expiry week. I mean, expiry week, the technicalities of expiry, let's say I'll look at in a little while. But it tends to be a fairly quiet time. I thought we could see some dramatic action next week in some kind of third wave rally. I mean, the market is always delights in surprising everybody. The majority is always proven wrong eventually. So if everybody expects one thing, then the other thing will happen. Hence why we're rallying at the moment to a large extent, I think. I mean, there's so much fear in the market back in March 2009, and that fear is still driving us up, in fact. But there's certainly a call, or certainly due a peak early next year. But having seen 5 waves up, there's a good case that it will only be a corrective decline. Even so, there's still a substantial the corrective decline of the rally since March 2009, which is a 2-year rally. The market's gone with the precise levels now, but 2,000 to 3,000 points up. So you can see 1,000 points down, perhaps. So my current position is we're going to see a major peak, probably in January, and we're going to fall away for a few months. And it's the form of that decline, takes, which should give us some decent clues about what comes next. Mark, over to you.
Okay, the next question. So I think that the markets are holding up mainly because there is fear of Armageddon. Given that the FTSE should have dived over a year ago, what is your best guess for when it is likely to plunge, and by how much? Okay, I'm going to answer you as honestly as I can here, and the honest answer is I don't think anyone knows. In fact, I don't even think the government knows where we're going to be in 2 to 5 years. Very, very, very difficult to predict. As a trader, our job is to trade what we see, and we don't want to get sucked into complex macroeconomic situations, because all that's going to do is it's going to cloud our judgments and make our trading very, very complicated. Now, personally, when we had this sharp rally in September, we had all the American news about how the bailout measures were occurring, and I started to really delve into the economics behind this, and all it did was hinder my trading. So if there's one piece of recommendation I can sort of tell you, it's keep things simple. Don't analyze things too much. Follow what your strategy is telling you, and if your strategy is telling you it's going up, then you follow your strategy. Okay? Don't worry about what's going to happen in a year or 10 years. No one knows this. It's also worth noting that the very experienced professional long-term option traders, they are usually wrong. So, if they can't get it wrong, then it's going to be very difficult for a non-professional trader to sort of call the right stance. Okay, John?
Why is option expiry day important to price action, and what options actually expire? I thought options were mainly an American trading vehicle for individual US shares. Okay, well, let me deal with the last part first. There are options on basically everything, I think. In the UK, we have options on the FTSE 100. We have options on all the different shares. We have options on the futures, I believe. Maybe not so much in the UK, but certainly in the US. This is where the triple witching hour comes through. So in fact, it's the actual options on the indexes, which I think are the most important ones, in the sense that there are massive amounts of money in these options, and it behoves these people, these big banks and big traders, to manipulate the market so that they get good prices to start with, and that they can exit at excellent prices at the end of the process. So the whole expiry cycle, which goes from the third Friday one month to the third Friday of the next month, can be governed almost entirely by options expiry, and therefore it's quite a key technique, I guess. What you often see is that the 2 weeks into expiry tend to be a little bit quieter, whereas the 2 weeks after expiry can be quite active. In fact, I used to build a whole strategy about just selling options in the last 2 weeks and then hedging with futures, That worked really well. Not every month, of course. Nothing works really well every month. But it is something that is hugely significant. And also you do see very often major moves after expiry. I suppose the 87 crash is a good example, whereas in the US, the options expired on the Friday before the huge crash, and on the Monday following that, we saw this huge 500-point decline. But it happens again and again. We often see very sharp action after expiry, and it's one factor that certainly helped me a lot when I was trading in 2008, 2007, 2008. It was a factor that made some of my calls during that period extremely profitable for both myself and my subscribers. So there's a lot more than just options on individual shares. You can both buy and write options. Writing options is a professional activity. It's not something I recommend, in fact, to people who just do this as a hobby, if you like, because you can become incredibly unstuck. The problem with options is, in fact, if you sell them, or write them as it's known, is that you're accepting a fixed amount for your, rather like an insurance company or a bookie. You're taking in fixed amounts, but the amount you may have to pay out if it goes wrong can be quite a large multiple of the amount you receive in, and that in a way flies against the traditional idea of trading that you actually risk a little to make a lot. With options, you're making a little with the possibility exposure of a lot. Although in fact a lot of just to finish this on options, the biggest problem I find with options is that the potential risk is so high that you're forced to hedge. But generally, if you hadn't hedged, you'd do very well. So if you're just prepared to accept the huge risk, ignore it, have a really unpleasant month every now and then, but don't hedge the rest of the time, you probably do very well. But I mean, that's something that is a personal decision. So I'll now get on to Mark, over to you.
Okay, I just want to spend a little bit of time now, because for my subscribers who are logged in today for your morning, we all know that I introduced a new structure to the service this week with the new morning alert service. So I've given you how to use it, but I haven't really gone into why I've introduced this. And it's really down so I can give you more opportunities. Now, the majority of my income through the FTSE is made in the early morning. Okay, so I'm looking at very early morning trade setups. Okay, so if you don't know, the first hour of the FTSE creates the most opportunities, and that is where the price inefficiencies are. So remember, with my service or my strategy, I'm concentrating on price inefficiency. So in effect, I'm taking the cream off the top of the market and I'm using that for my advantage. Now, of course, this is a new service, and with any new service, it's all about testing new methods. So for me, it's all about how to deliver information to you, the subscriber, the best way. So the best way is quickly and efficiently. So before, when I was sending SMSs at 8 o'clock, 8 o'clock for me, it's the period of time when I'm focusing the most on the market. Sending SMSs at this point in time is a rushed exercise. We had some success, well, quite a bit of success doing it, but even if you entered, you were not getting at the same price as me. So now, by this new structure, we're all looking at the same signal. You just need 5 minutes to look at my email, and if we see the signal, we enter the trade at the same time. So we get in at the same entry, and we're going to exit at the same time as well. So we enter at the same time, but I will use the SMS to then manage the trade for you. Okay, so worth noting also that when you're trading, the entry isn't actually that important. It's the exit which is most important, and that's where many traders find it's difficult. So I've touched on that. 8 o'clock, that's where the most opportunities in the FTSE are. So we're going to be doing some more trading at 8 o'clock, and I'm going to be managing these trades for you. So once we're in a position, some of these, ideally, I want to run these positions, and to maximize profit. So they could go on for 1 or 2 days, or it might be a quick 12 points to 30 points. So also I'm going to continue with the chunkier trades as well, but I think using the morning trades, we're going to have a little bit more time. We can be a little bit more patient because we're getting regular income, so we can look at getting the best entries. And now on the morning alerts as well, I might even try testing getting in before 8 o'clock on some occasions. This means it's not quite so volatile, and I will do that if I feel very confident about the trade. So yeah, lots to look forward to, I think. Okay, John?
Thank you, Mark. What's next on this? Okay, question from attendees. I think I'd like to do here, have the ability to actually unmute individual people. If you put your hand up, there's a button, I believe, where you can put your hand up. If you'd like to ask a question. Okay, I've got one here. Let me see if I can do this, Andreas. Okay, you're online, Andreas.
Can you hear me, or do I need to type?
No, that's fine. That's fine. We can hear you. Well, I can hear you.
Oh, okay, that's good. Yeah, it was just touching along what Mark said there. I was going to ask a question why he was waiting until 8 o'clock when before the market opens. There seemed to be a more attractive entry point, but he did just touch on it there, that he was thinking of changing it and perhaps
Andreas, let me just, I need to transfer my headphones to Mark.
Okay, it's fine. I'm just turning the volume up.
Okay, now Mark's just increasing the volume. So, sorry, Andreas, do you mind just repeating the question part?
Can you hear me now?
Yes, I can hear you.
Yes,
sorry, Andreas, I had to turn my volume down because obviously I've got an echo by hearing myself speak. So go ahead.
Yeah, that's okay, that's fine. I was actually, you just did touch on it there. My question was why you would wait until the market opens rather than perhaps before the market opens to enter a trade when the price seems to be more stable and more attractive. But as I say, you did just touch on it there.
Sorry, Andreas. You're asking about the market opening before 8 o'clock?
I was asking about entering the trade before the market opens.
It's a shame. Yeah, it's the internet's not feeding that through. Can we type this?
The question is, why not trade before 8 o'clock? Why wait till 8 o'clock to trade?
Oh, right, okay. Because sometimes if I'm not 100% sure on the trade, I need to see the first opening price. So for my system, in some cases, if we open over a certain level or we open under a certain level, then I don't want to be trading it. But obviously, if my criteria is met before the trade, before the market has opened, then I can enter straight away. But generally, if you want to lower your risk, it's best to really wait for the signal at 8 o'clock sharp.
Okay, let's go on to the next one. Thank you, Andreas. Thank you. Okay. Right. I thought somebody else's hand went up. Oops, came down again. Oh, that one. Okay, Lucian. I'm just you're now on, Lucian. Do you want to ask a question? No, obviously not. Okay. In that case, we'll go down to the one here. Paul Jones. Can you? Would you like to ask a question?
Yes, this is to sorry. This is to Mark.
To Mark. Okay.
Yeah, this is. Where does he see the FTSE? Where does he see the FTSE going in the next couple of days, 2 or 3 days? Because he's on about this decline and then the sharp move upwards.
Okay, if you just repeat the question to me, John.
The question is, Mark, where do you see FTSE going in the next couple of days?
Okay. We are currently we're either still in the B wave, as per my analysis, or we are phasing out a triangle, and we could shoot up next week. All in all, the market is very, very bullish. I'm not keen to take very much short exposure at all. There's just too much good news out there at the moment supporting the markets, and it really does rest on this European crisis. As long as there's no negative feedback on that, then the FTSE is still heading to 6,000. But I did sort of mention on my analysis a few weeks ago that I saw the FTSE bouncing around levels between 5,530 and 5,850. At this point in time, that seems to be panning out. So we're either going to have very, very dithery action until Christmas, which is possible because the markets have done absolutely everything opposite this year to what they usually do. I mean, September was an unusually bullish month. In fact, the most bullish in 70 years, and usually it's a time when markets retrace quite a bit. So the December rally, which we're all waiting for, may not occur. But at the moment, it's still looking very bullish, so try and position, well, I'll certainly be trying to position the FTSE, subscribers on the long side if we look for a swing trade. And then obviously on the morning alerts, we go long or short depending on the signal. But that, to me, that's a safe option at the moment. Until I see a very, very clear signal, I would rather produce income on the morning alerts.
Okay, thank you, Mark. Okay, we'll now go to the written questions. One from Azza, Mark, and we're going to deal with this. When do you know when a trade is not working to plan, so one can get out quickly?
Okay, Azza. I think it's very important that you recognize that when you take a trade, you place a stop in your trade, and your stop is a predetermined level of risk. So if you come out of a trade early, effectively you're not following your strategy, you're not following your system, and you're not allowing your stop to do its job. Okay, so when you enter a trade, you really shouldn't be thinking, okay? If you start thinking, you're going to let emotions come into play, and you might come out of a trade which could then reverse, and you've missed opportunities. It happens to me sometimes, and it's a struggle, but the best thing to do is allow your stop to do its job, and try not to question the markets. Follow your system.
Okay, there's another question here which I'll answer. If I decide to bet on oil or gold or the dollar, etc., going down, I look at my IG account and see daily prices and futures prices. How do I choose which to utilize? The big difference is the spread generally. That the spread can be a bit of a problem in the sense that the spread tends to be more in the futures than it is for the daily rolling. On the other hand, the daily rolling can, in certain cases, be closed on that end of that day, and your profit or rolled over in that day. So your profit and loss is shown based on just that single day. So if you say, for example, that you had a say a £200 profit or something, but that day shows you £50 down or whatever, then you might think, am I going down and get out? Whereas with the future, it will show you the total profit or loss over the entire trade, which may be more useful. Also, the futures will always be there, in the sense that that trade will not be closed out. So it's a question of what suits you best. I tend to use both. It depends on what I'm trying to do at the time. With day trading, I use the rolling prices. Longer term trades, I tend to use the futures prices. Okay, I hope that answers that question. Just scroll down. Okay. Right, in my excellent book, The Way to Trade, I mentioned the attraction of being hooked to one method, e.g. Edit Wave. It seems to me you service Edit Wave as a core to your analysis. So how do you get the right balance? It's quite difficult, but I think it's important not to actually have too many indicators. I used to work with a guy called Jerry Favors in the US, and he basically covered every single indicator there was going, I think. And you're bound to, I think you cover so much, you're bound to end up just getting so many contrary signals. You're almost forced to be subjective. So I think the key thing is to develop a strategy which works using a limited number of strategies. I just find Elliot very useful for telling me where we are in the market. It's not always right, of course, but there are times when you get low risk opportunity. And I guess this peak I'm talking about, the peak I'm talking early next year, might be such an opportunity where we've got a fifth of a fifth. We've got the seasonal factors working in our favour as well. Doesn't mean it'll all work out, but there just seems to be quite a good case for there being a major peak in coming weeks. So I think it's partly experience. It's partly just developing something which works over time. And I mean, certainly, in the past, I've checked out different strategies, used them, and either kept them or dismissed them depending on how I felt about them. That's why I don't use many indicators, I guess. I think indicators are just made up of the price, so I don't know what extra you get from an indicator. So I hope that question has been answered. A question for Mark. You said you use leading indicators instead of following indicators. Can you give us some ideas of leading indicators, please, from Aaron?
Okay. Well, leading indicators. Well, there's things like systems. For example, POM is a leading indicator. Gap theory is a leading indicator. Elliott wave theory is a leading indicator. To a certain extent, pivot points are. Anything that isn't a leading indicator fits into things like RSI, MACD, statistics. They're all lagging indicators. I mean, John, can you think of any leading indicators that you use? I mean, you're predominantly based on Elliott, aren't you?
I guess Elliott is a leading indicator. I would say so. You've got a trend line. I mean, it depends on what happens.
I mean, volume's another one. Volume's very important. In fact, I've missed the most important one. It's getting late in the Philippines. Price action. Price action is your number one leading indicator, and by price action, I just mean your chart. So remove all your lines, all your indicators, and what you see on your chart, the price action is your leading indicator. So if we're seeing a failed retest or a false break or a price spike, these are all leading indicators. Okay, so it's giving you information on what the market's going to do next, rather than getting information from lagging data.
Right, two more questions for you. Where do you see the current B wave ending?
Well, it shouldn't go past 870, 5870. If we go past 5870, then my analysis is simply wrong. We could just dither around. Ideally, we should see the B wave finalize under 850, and we should have the C come into play next week. If we go past 5870, then it's simply going to keep going up.
Okay, another one for you. Which site do you use for your gap data? I understand your system, and I use IG Index and monitor FTSE 100 daily prior to 8 AM, but I find the figures posted in the email don't match what I'm seeing on IG Index. Okay,
that's because I have calculations, and I basically interpret the gap data quite differently. Unfortunately, I can't go on the phone now. I really need to illustrate it, and it's something that I teach at my seminars. But there is a specific system which I use for the gap data.
Okay, one I'll deal with. I've just had a visitor, so missed some of the webinar. Is it being recorded? In fact, we've got 3 recordings going on at the moment. I want to make sure we didn't actually miss this. I want to make sure that people who had some problems do get copies. So I'm certainly hopeful one of these 3 methods will actually produce a recording which we can use and send to you. So yes, the answer is yes, certainly that's our plan. As I said, this is our first webinar, so I'm a little bit hesitant, but I think that should be okay. Okay, question from Ken. Mark, what is your long-term hit rate for the gap trades near 8 AM?
70%.
Okay. Another one for you. It would be helpful to understand some of the jargon used on the ATM setups. I sometimes am not clear on the circumstances you are describing.
I mean, just send me an email. I mean, I've really put my hand up. I can sometimes get caught up. I mean, being a trader, I know for you guys, communication is the most important thing. So if there's something you don't understand, then just let me know. But I mean, in terms of the morning alerts, I hope over time it's going to become a lot easier if you sort of recognize or understand what I'm talking about. But as I said, at this stage, I am keen to make things as simple as possible. And you know, as the service evolves, I just want to try and make it as more profitable and easier for you to follow.
Okay. Hi, Mark, John. Thank you for the seminar. In your experience, what percentage monthly returns are realistic for an experienced trader?
I mean, it's everyone's independent on this. It depends what risk you're using. It depends how big your bank is, or sorry, your trading account. So impossible for me to answer that. Sorry, John.
I'll just say a few things. I mean, I think one of the big issues is actually risk tolerance, because I mean we all have different amounts of cash available to trade, but some people are very happy trading £1,000 a point. Others are unhappy trading £10 a point. And this obviously can have a very large effect on your returns, not your percentage return so much. Well, it can do. If you've got a bank of 100,000, you're happy trading £10 a point, then it's going to have a huge effect on your percentage amount of returns. This is a psychology aspect, which is a big issue. I mean, as Mark said, it's a very personal thing. I always felt 2% to 4% was a good benchmark to aim for. Not too huge. 2% to 4%, you're not risking huge amounts, so the risk of being wiped out is far reduced. And that's kind of what I would actually aim for. How long does it take to get to this level of competence? It's such a personal question again. Some people just go straight in, and people who are market traders in the sense they may have sold stuff on the street often have a very good feel for what trading is all about. Other people, perhaps highly educated, don't have that sort of basic gut instinct. And it just depends on the individual concern. So it can take many years. Some people, a few months. It's it just depends really. How are we doing now? Okay, here's the question. I'm just about to set up a trading account so I can trade. Can you give me any advice to help me with my first few trades? Actually, one point that we're going to cover is starting capital. Do you have any points on starting capital, Mark?
Well, I mean, the first thing I would say, if you're just starting trading, then try using a demo account. All these spread betting companies these days give you a demo account where you can just practice your trading, get familiar with what you're doing, and then start committing a small amount of money and build it up. In trading, patience really is key. And there's far too many people who approach the trading arena who are impatient and want instant returns straight away. But by being just a little bit more patient, the rewards will come.
Can you give me advice to help me with my first few trades? Yes, don't risk very much. Keep it small. Just do it gently. Be relaxed. Don't worry about. You're not trying to build Rome in a day. You're trying to just build something that's going to last your lifetime. So just take it slowly. Many people just rush in. But paper trading is a really good idea. In fact, you do say you intend to paper. That's really good. Question about stops. Are you entering actual stops or using mental stops and market profile techniques? It depends. I normally use mental stops, in fact, unless I have to go out or something's coming up I need to do. And it depends on the type of trade, really. I mean, I tend to have long-term stops in place just so I haven't got to worry about what might happen. But if they're close to market, then I only put close stops when I do something else, really. Market profile techniques, I tend to use spikes, really. I mean, spikes are more useful from a stop point of view. A good spike is a good point where the market is rejecting price, so it's a good place for a stop. And it says PAN here has suggested that spikes are the leading indicator, which is very true, I think. Charting software, I use UpData and Morningstar. I think that's probably we ought to be on to the next section of the seminar. I think we're actually running out of time a little bit. So trading insights and Mark's seminar DVD. We just produced them. As you may know, we had a couple of seminars in October. Mark had a day seminar, and then we had the POM seminar the day after. We just actually produced the seminar DVD of Mark's, and if you're thinking about coming to one of Mark's seminars, then it would be well worth buying this because the cost of that will be offset against the cost of the seminar. And also we knocked it down quite substantially from 795 down to 497. So if you're interested in that, then we'll be sending you an email later if you're interested in that. And you also get my Trading Insights DVD included in the package. Anything to say about that, Mark?
No, I mean, I'll send information on the email about that.
Okay. I mean, on Mark's seminar, he does cover all his trading techniques, and if you're interested in what he does and why he does it, how he does it, then I think it's very useful.
Yeah, I mean, the benefit with people who come to the seminar is that they know what I'm looking at, so we can interact, and so they're really seeing what I'm seeing as well. I mean, the whole idea of the service is to really bring you to a level of trading where you don't have to be reliant on me, forever. Ideally, I'd like you to be part of the FTSE service forever, but really, it's really there to educate you and give you the right skills to succeed at trading. And I go through all this at the seminar, and pretty much go through my systems. I have quite a few, and why I pick the trades I do.
Okay, notice we've got actually one verbal question from David Harrison. David, let me unmute you and we can ask, would you like to ask a question? David? Oh, not any sound. Okay, we'll have to go back to... Okay. Okay, so a few more questions then that we have. This is you, Mark, actually. Why do you concentrate on the FTSE when currency pairs have a wider daily spread and 3 more opportunities?
I think we covered that one before, actually.
Okay, let's go on to the next one. Okay, for me, when spread betting, is there any way to prevent a spike for just touching your stop level? That's wiping you out, well, out of a trade, presumably, rather than wiping out entirely from one trade. And then the market going back in the direction that you have bet on, and the answer, of course, is using acceptance, which is meaning that the market has to spend time beyond your stop point. Now, the biggest problem with this is that you can't put an acceptance stop in the marketplace, at least I'm not aware you can. So it's something you have to watch, and of course, when you're not there to watch it, you really need to stop in the market so that you're not exposed to a very sharp move. Okay, let's go on to the next one. What does parity mean in the concept of tunnel trading? Actually, we're going to have a tunnel trading webinar, in fact, in a few weeks' time. So I don't really want to go into tunnel trading in this session, but we'll be doing that in the fairly near future. But parity, just for the sake of taking a second, parity is the prior day's close. It's where FTSE is unchanged on the day, or the Dow is unchanged on the day. It's a fairly simple concept. Okay, a few more. Is it possible to double your bank every month, or is that pie in the sky? Yes, it's pie in the sky. Of course, it does happen. I've done it myself a number of times, but it's not something you can. Well, not every month. I've done it myself occasionally, even in a week once, but it's not something that you can expect to happen. And the problem is that the strategies you have to use to do that are such high risk that you wipe yourself out generally. This might be for you, Mark. Look. Are you getting attracted by the MACD indicator? It seems.
No, we've done that one.
We've done that one again. Sorry. Just look on this one. Hi guys, the fundamentals are dreadful. Everything says the market should fall, but the uptrend seems endless. Technicals. After you, Mark.
I mean, it goes back to what I was talking about before. Try not to get too hung up on the long term, where the market's going. I mean, I take a 3-day basis up to a week. That's it. Anything over that, it's really quite difficult. And if you're day trading, it's irrelevant. You just want to be looking at right up to the minute information.
Okay, we've got about 5 minutes left, I think. So, what are unfilled gaps? That's the question mark.
Okay, so it's an area in the market where no trade activity has occurred. So the prime function of the market is to maximize trade, and the market makers, for those who don't know what a market maker is, a market maker is basically someone who matches up buyers and sellers. So if there's an area in the market where there's been no trade activity, that creates a gap. And the reason why gaps, the market retraces back to gaps is because the market wants to maximize trade function, i.e. not miss areas.
Okay, thank you. Will you be looking at index options on FTSE as an alternative way of trading? Options are something I've done a lot of trading with. I feel writing options is a professional strategy. It's not something I really want to encourage other people to do, to be honest. I mean, I'm very happy that people who are serious about trading write options, but you really got to be serious, otherwise you can lose a lot of money doing that. Buying options, they tend to be too expensive, really. It's very difficult to make money buying options. The traditional result is that the market does go your way, but you don't make any money anyway because the thing is so expensive that the gain in intrinsic value, which is the amount of money that the options in the money, is totally outweighed by the time value, which is the amount premium you pay for that option to carry on for much longer. So, okay, that actually covers the question at this point. I appreciate we haven't answered everybody's question. It's quite difficult to do so in a session like this. Questions keep coming in, and we'd love to do so, but we will. We plan to do these monthly, in fact, so we will be looking to cover other questions. I think we have covered all the points we said we would in the brief promo I sent out. So we'll just finish with this, with the fact that some matters we covered in the POM seminar in October. 6 key trading tactics for radical change to your trading business. So Mark, do you want to cover the disciplined emotional control trader's mindset?
Yeah, I mean, I touched on before that with any professional business, and particularly trading, if you want to take it seriously, you have to treat it seriously, and that involves discipline. So I'll just take a very vague example here. So in an office, you're obviously not allowed to smoke. That's a rule, and you're disciplined by following that. If you have a rule in your trading or any business, you have to follow it. Otherwise, you have to ask your question: if you had a separate business, would you be taking unnecessary risk? And hopefully the answer is no. Emotional control, that is a must. As I said, I talked about this in depth with my previous seminar, and there are certain key things that I use to help me. Very, very important to keep your emotions in check. And if you demonstrate 100% discipline and consistency, then eventually you get trader mindset. And this is when you sort of act mechanical. Things flow very, very easily. Underneath that.
Okay, a solid system. So one point is just to have a good system, which gives you clear entry points and a good hit rate, so that you know you have an edge. I think this is a pretty essential thing. This is why we started POM, actually, is to give people this. So something which is simple, reliable. They can do it in the morning, early on. But there are other systems. There's many systems around. It's just a matter of finding one that gives you that edge, and that's what's so important.
I think with all systems as well, you can adapt them as well. I mean, you get the whole point of a system is it gives you a framework, and within that framework, you might discover a way that that creates more money. I know we have one client at the moment who's using POM, for oil. And what's it? How many wins in a row? You said 16 or something?
16 wins in a row.
16. I mean, fantastic. But he's taken the system, he's adapted it to his own market or personality, and he's doing very well.
Yes, which is the next point, research. What is so critical is to put in the work and do the research. It's something that people seem to shy away from. I'm never quite sure why. But unless you do the research, then you never become the expert. And good traders are experts, so it's important to do that. And in fact, the POM, again, I don't want to keep referring to POM, but part of that strategy, part of the service, is to help you to do research, as in fact the oil trader has been doing. It's just critical. A flawlessly executed strategy, Mark.
Yeah, I mean, this just comes down to, the professional traders, they have a strategy and they follow it 100%. Now, it's interesting to note that university graduates, in America and the UK, they finish their education and they're snapped up by big brokerage houses or banks, and their prime their prime role is to come into these banks or brokerage houses, and they're given a very profitable system just to trade for the bank. So they use this system, and they make a lot of money, and they see all this money coming in, and eventually, these young kids, they start thinking they can take the system home. Hang on, why do I need to be working for someone else? I could just take the system back and make my own money. But what happens is they're taken out of an environment with discipline and risk controls, and when they're put into their own home environment, suddenly they start losing money. I mean, that's probably the most perfect example I can give of why discipline is so important.
Okay, one quick question we got here about the POM seminar. Can we offer that online? In fact, we have recorded the POM seminar, so you do get a DVD, so you don't need to attend in person. You can just get the DVD and the system and work from that. So the next point is selective trading. I think it's very important to actually develop your expertise, so you just don't trade every single signal. I mean, there often are situations where it's not sensible to go in. I mean, for example, recent research shows the first day of the month is often a strong trending day, so you need to be quite careful with that particular day, for example. And I guess the final strategy, risk and money management, risk control and money management. I mean, traders had to be risk averse because there's a lot of risk around, and if you're not risk averse, then it will get. And money management, well, we've touched this before. If you risk too much, then the fact that every 1,000 trades at 50-50 and hit 10 or 11 losses, you've got to appreciate that fact. You've got to use good money management. Mark, any final comments?
Yeah, I mean, also, if you're not following the risk, then you're not going to have any money to trade with in any case. So, it's paramount to operate like that and accept probabilities. There will be times when you're hit with 3 or 4 losses in a row. That's markets, but don't be phased. If you've got a system which has a 70% hit rate, then the profits are going to take time, are going to follow over time. So don't worry about it.
Okay, well, just want to say thank you very much for attending this webinar. I hope you found it useful and interesting. We have recorded it three different ways, so we certainly plan to send you a copy of that. We'll enjoy the rest of the day. It's now about 9 o'clock over here, 8 o'clock over here, so it's time for something to eat, I think.
It's time for a beer, actually, John.
Yes, thank you very much again.
Okay, thanks for attending.
Bye-bye.